Mines and Money London 2016. Welcome, ladies and gentlemen. With me here is now Denison Mines and David Cates, the president and CEO. And of course, we want to talk about his terrific company, but also about the uranium market. David, good morning.
Yes, good morning. Thanks so much for having me.
Yeah, thanks for taking the time. Denison Mines, where are you located? What are you doing?
Right, so Denison is a uranium exploration development company. It's focused in the Athabasca Basin in northern Saskatchewan, Canada. Our assets are really focused actually in the eastern part of the basin. So in the east we've got infrastructure, the Cigar Lake mine, the MacArthur mine. Both of those mines are feeding mills in the area. One is the Key Lake mill in the south, and in the north is a mill called the McLean Lake mill. And we actually own 22.5% of that McLean Lake mill, and today we're processing 100% of the ore from the Cigar Lake mine. So it's generating toll milling revenues for us right now.
Oh, that helps always, yeah?
100%. Our flagship asset is actually located between the MacArthur River mine and the Key Lake mill, and it's called Wheeler River. We're 60% there, and our partner is Cameco. They're at 30%, and a Japanese group at 10%.
Great, fantastic. So in what status are you with the Wheeler property then?
Right, so earlier this year we launched a PEA, or we issued a PEA for the project. We put out really solid economics, a plus 20% IRR at $44 uranium. And what we've done is right after that we launched into PFS work. So we've started with the initial baseline work and some preliminary engineering, bringing our resources up to a higher classification, get it to that indicated level, and then we'll be looking to finalize a PFS probably in the next 12 to 18 months.
Great. How many pounds you have so far, and which categories are they?
Yeah, we have two deposits there. One is the Griffin deposit. It's 43 million pounds at a grade of 2.3%. About 3 kilometers away, ultra-high grade deposit, the Phoenix deposit, over 70 million pounds at an average grade of 19%.
Wow.
That's the highest grade undeveloped deposit in the world. So take it all together, you're around 114 million pounds of all categories.
So when you say 19%, that sounds to me really, it is ultra high, but can you still mine it with a normal method, or is, let's say, the nuclear impact a bit higher than normal, of course?
Yeah, there is radiation associated with such high grades, so you do have to use special methods. What we've planned right now is to use the same methods they're using at Cigar Lake, which is a very similar ore body, so it involves remote mining. Over at Griffin, where it's the 2.3%, you're low enough grade that you can use conventional low-cost mining. And so in our mine plan, we actually start with Griffin, and then we go over to Phoenix. Even though the grades are lower than higher, it's all about higher margins up front, and we'll get higher margins out of Griffin.
Okay, fantastic. What is the time frame you could see a production start? Just, I know it's a forward-looking statement, but just to give our viewers an idea.
No, of course. I mean, we've put a timeline out with our PEA. In Saskatchewan, these projects do take time. There's a tremendous amount of permitting and environmental work that goes into it. So we're looking at construction around 2021 and first production towards 2025.
Great. Okay, perfect. So this is, I would say, a time frame which is long enough that we have time that the uranium prices restart to rise, hopefully.
Yes, exactly.
And as you said, at $44, you have an IRR of 20%.
That's right.
So where do you see the uranium market today, and could you imagine that we get a restart maybe next year, as some people already predict, because you're also working with UPC, Uranium Participation Fund. So what's
well, the uranium price right now, it's at a point that's not sustainable, and you look at our project at Wheeler River as an example. This is a project that, despite having that long lead time, is actually at the front of the line amongst many other projects because the economics work at a price of 44. So many of the projects in the world only work, and they've only really run their economics to work at $65 or $75. And that goes to what you're talking about, which is where does the price go? Well, if the price stays where it is now, no new mines ever come into production. And then eventually, and not that long from now, the demand just simply eats up all of the inventories, all the supply, and none of the miners can actually put mines into production, get uranium out of the ground to actually feed these clients, right? And I use an example of a particular mine in Kazakhstan. We look at the all-in cost curve of all of the projects in the world, operating and in the pipeline. So on an all-in basis, the break-even, so not even like an incentive price, the break-even for for the very best mine that's operating in the world today is around $21, right?
We are 18.50 the spot price.
Exactly. So that means that the best mine that exists today is
Yeah.
operating. You couldn't justify building it in this environment. That tells me the market is totally out of whack.
Great. Okay, so that sounds like a screaming turn, I would say. But we saw it in copper this year anyway.
Yep.
I think it's a bit similar, the situation to me. Given your, let's say, advantage of information, I would say, through the UPC participation here, can you say something about world storages of uranium? Like, because I've heard very often, the Japanese power plants, they have so much storage and this comes into the market and that's why it's so low. Is that really true?
Well, I mean, it is true indirectly. At the end of the day, the market is soft because there's more to be sold than there is to be bought. That's only in the immediate term, right? So there definitely is more material for sale than there are guys buying it today. But the utilities aren't actually buying. So they've built up some inventories, they're doing some discretionary buying. What they haven't done is the large-scale cyclical buying that they need. I mean, these nuclear power plants run for 40 or 50 years.
Yeah.
They have to buy material on a long-term basis to make sure that they have supplies
Absolutely.
to make power, right?
Yeah.
That's what they haven't been doing. When that starts, and that's where I see the real catalyst in this space, when that starts, any of those other supplies and anything else that might be oversupplying a really thin market now gets wiped right out because they're buying pounds on 8, 10, 12-year basis, right? And at that point, you're looking into the pipeline like we were talking about earlier. There's no new supplies coming into the market because nobody can justify building a mine.
Okay. Do you see, let's say, any, or not any, but do you see already a bit from the buy side into the UPC that maybe some large investors say, oh, maybe it's a good idea to buy a bit more in the physical stuff and to be prepared for a rising market?
For sure. We do a lot of marketing, and we do definitely see investors looking to do that, to money work in the space. Earlier this year, and just actually in October, so not that long ago, we raised just over $20 million for UPC, and we went out and we bought uranium. So that was a very first move, it's kind of putting the toe in the water, but there are investors willing to stake a company like UPC to go out, buy uranium at these prices, knowing that it's going to go up in the future.
Okay, interesting. Can you give us a bit of an overview about, let's say, the supply side? From where comes the production? How many pounds do we have? What is, let's say, recycling?
Right.
Can you give us a bit of an overview?
Yeah, I mean, the easiest way to think about it is on the primary side. If you look at real demand versus real supplies from like primary production, we're about 20 million pounds short, generally, every year. That means that the market's filling that in with the secondary supplies. So strategic inventories, underfeeding as a source of secondary supply, that's filling that gap, and then actually putting a little bit extra on top, which is giving rise to this thin but soft market.
So how many pounds of uranium were produced this year, roughly?
Well, yeah, you'd
Do you have an
be
idea?
in the 150, 170 million range.
And the demand is then like 180, 190?
Exactly.
Okay,
Yeah.
wow.
Ballpark ranges.
Yeah, interesting. How much pounds, maybe you know that, I have no idea, it just comes to my mind. How many pounds do you need to feed, let's say, an average nuclear power plant per year?
Oh, I never even
Because I
think
heard
of it.
something like 500,000,
Yeah, that may be
750,000.
right. I never even think of it on a reactor by reactor. There's so many of the reactors have different technologies. We take really more of a big picture view on it because it's just, you could totally mislead on that. But
Okay, no question. Let's come a bit finally also on the demand side from the nuclear power plants. I think China is going online every third month or something with one power plant. What is, let's say, like in Asia or in the Arabic countries? Where do you see there the demand side?
Well, China's the leader. I mean, when we look at the demand case, China is really the clear leader in that. They are actually bringing on 1 to 2 reactors every quarter. That's happening. And while they do that, they're putting 1 to 2 more reactors on to the back end of that pipeline pretty much every quarter. So you've always got this 20 to 30 reactors under construction and actually coming onto the grid in progression. But it's not just China. Korea also has a significant nuclear build program right now.
India?
India, of course. Yes, China and India, Korea. Korea is exporting actually into the Middle East, building reactors in the UAE. Saudi Arabia building reactors. And of course, we can't lose track of the Russians. The Russians are also building reactors and exporting those reactors to other countries. And really, the growth is not just China.
Yeah, and they all have to be fed.
100%.
I mean,
Yeah.
okay, perfect. So that looks like uranium is on the edge to restart, I would say, isn't it?
I think so. I mean, I think we've the prices dropped so quickly.
Yeah.
I think we've seen an actually fundamental correction happen. We're really at the point now where things can be set up to swing around, sort of a capitulation event at some point, where we will see market realize that the fundamentals are still strong and that this price doesn't work.
Yeah.
As soon as the buying happens, we start to see this price become very, very much pressured because the material becomes scarce.
Yeah.
And that's what we're all looking for.
Perfect. Great.
Excellent.
David, thank you very much for that. Merry Christmas.
My pleasure.
And look
Thanks for
forward to
having
meet
me.
you next year then.
Absolutely.
Super. Thank you very
Great.
much. Ladies and gentlemen, there was David Cates, the president and CEO of Denison Mines. And yeah, you heard it. Uranium is ready to jump, ready to start. Probably not this year, but for next year, it looks quite good. Demand, supply. We are in a supply deficit already. 20 million pounds per annum are missing. But still, we have the storages from Japan and also some other countries which are coming into the market. But as David said, even the lowest cost producing mine in the world in Kazakhstan is still at $21 all-in cost with a spot price of $18.50. That makes definitely no sense. And so from that perspective, I think we are bottoming out here, and it's getting interesting for uranium price, uranium space, and of course uranium stocks. So check out his company, Denison Mines. Thanks for watching us. Bye bye from London.